let's quickly take a look at the week ahead. The week ahead is going to be absolutely mad, guys. We've got a ton of important data coming up this week. That's good because it can obviously create some fantastic opportunities for us. So let's start with, today is, I'm not even going to look at today. Today, there is nothing of note that we need to worry about. The main focus will be Tuesday, Wednesday, Thursday, and Friday's events. Now, let's start with tomorrow. Tomorrow, keep in mind, the first thing that we'll be getting is the updated UK jobs data. Now, remember, we were supposed to get this jobs data last week. We didn't get the jobs data because, quote unquote, they didn't have enough survey information to release the data. Now, it might be the case that maybe they just didn't have enough survey data to release the information, but it feels a little bit weird, it's almost like they knew inflation would come in high or slightly higher than it did, and they chose to keep this data back. But anyway, that's just the conspiracy side of me talking a little bit. Let's look at how we can potentially trade it, right? Look, we've got two things coming up tomorrow for the UK. We've got the jobs numbers coming up first, which we wouldn't have gotten tomorrow. We would have gotten that last week, but obviously it's been extended to this week or pushed out to this week. So we'll be getting the jobs data first, nice and early. After that, though, we'll be getting the UK flash PMI data as well. And both of these two prints will be important because we didn't get much directional bias from last week's data, right? We had wages coming in lower, but inflation data came in marginally higher. So the markets remain, very focused on what the PMI, what the growth and what the labor market will show us, because that could, at this stage be something that dictates how the markets feels about the BOE's upcoming meeting. The one thing just to keep in mind about that meeting, though, is that if you take a look at rate expectations, and let's just do this. If you take a look at rate expectations, the markets remain very sure that we won't be seeing a hike at that upcoming November meeting, right? So that's the first thing that's important to note, meaning that whatever this data tells us tomorrow, it's unlikely to, even if it comes in very good, it's unlikely that very, very good data on the jobs or the PMI side would be enough to change the market's idea or mind that the BOE will, suddenly start hiking rates. The markets think they are done. And even if we get really good data, I don't expect that to really change what the markets are expecting from the Bank of England. The bank has been saying also that they are looking through the recent jobs numbers, through the recent wage numbers. They are specifically, focused on overall growth and obviously where inflation will be going. Also keep in mind that, fundamentally, there is very little to like about sterling right now. That doesn't mean that it can't pop higher if we get really good data. It could be worth a scalp to the upside if the data comes in really good. But it won't be a trade that I'm particularly interested in, with the exception maybe of one possible opportunity, which we can touch on in a second. But my preference would be, the best case scenario for a trade is if we see a massive miss across the board in first the jobs numbers and then followed through by the PMI data later, because that will confirm what the markets expect from the Bank of England, that the bank is done hiking rates and that they are, looking to potentially cut rates maybe even in the months ahead. So that is where the focus will be. There is a minor challenge with trading sterling lower on a big miss, though, and that is that, the currency has seen a lot of downside in a very short space of time. We looked at that a couple of sessions ago, saying that fundamentally you don't want to be long this thing at all because there's more reasons for downside than upside. But at the same time, you have to consider that, you have seen a lot of downside already. And at some stage, seeing a bit of mean reversion just won't be that much of a surprise. So the one negative that we have for shorting sterling on bad data, even though that would be fundamentally the best thing we could hope for, is that the pair or the currency has seen a lot of downside. So there is always that risk of mean reversion that we just need to keep in mind. Now, if we quickly take a look at the calendar, since we have the French and the German data coming up as well, the best case scenario for a trade would be if we see a massive miss in the jobs number first, followed up by a massive surprise beat in the French and the German data. That could open up a really good short-term scalping opportunity higher in euro sterling out of the event, especially, if UK PMI data comes in weaker after that. The one big risk factor just to keep in mind about euro sterling, and this is the main reason why I didn't buy euro sterling on Friday with that bad retail sales data, is we still have that huge jaws gap between the yield differentials and the pair. As long as that stays intact, the risk is that even if we get bad data on the UK side and good data on the euro side, there is a risk that we just see a little bit of a move higher and then the markets push it lower, just like it did the retail sales data. You want to wait for this relationship to even out, and we would expect that relationship to even out. Now, keep in mind, just because you've got this divergence, it doesn't mean that price has to come down. You could actually see the yield spread pushing up as well. There's many ways you can see that relationship even out. So even though it's risky buying euro sterling at this level, as long as we have this differential, the one thing to keep in mind is that if we do see very, very bad data on the UK side, followed by very good data on the European side, that in itself, apart from pushing the pair higher, that should actually be enough, at least in my opinion, to see yields, the yield spread pushing higher as well. So there is a lesser risk if the data comes in very bad for the UK and very good for the euro, for the Eurozone, because that should actually create enough momentum for us to start closing that gap. As long as price stays above the 200-day moving average, let me just show you guys here. As long as we stay above the 200-day moving average, if we can just see yields pushing up, we would be right back to buying euro sterling, without a doubt, right? I want to still be long this market. We've had a couple of very good trades on this on the long side over the past couple of weeks, but I'm waiting for that to show me that there's enough reason for me to get in on the long side. With that yield spread as it is, it's a bit dangerous, it's a bit risky. But again, let's wait for the data. If the data comes in really bad UK, really good Eurozone, it should be enough to see that yield spread, a divergence dissolve a little bit. And if it doesn't, you can just get out of the trade a lot quicker, right? If we do jump into a long on bad UK, good Eurozone data, if we do slam into key resistance areas, we would look to move to break even anyway. And if we then just see the yield spread doing the same thing, even on that data divergence, or worse, pushing lower, we'll just be getting out of those trades very, very quickly. Now, the other thing that we have tomorrow, apart from the UK and the Eurozone PMIs, we've got US PMI data coming up as well. Now, this isn't the ISM, this is the S&P Global. So it's not as important as the ISM for the dollar, but it's still a very, very important print to keep in mind. Now, we know that right now, both yields, if we take a look at US 10-year yields, trading close to 5%, and the US dollar, both of them has been looking a little bit stretched on the upside, right? And that is actually confirmed by the positioning data as well. If we quickly take a look at the updated positioning data for this week, let me just show you guys here. Here we go. So if you take a quick look at the positioning data for Friday, we go to currencies. You can see that the dollar aggregate, not the dollar index, that's different. The dollar aggregate is trading very close to the 100th percentile going back over the last 52 weeks. Now, that in itself doesn't mean just short the dollar with any opportunity you get. It means that if you do get a reason for the markets to push the dollar lower, there is more reason for those very stretched longs to capitulate on their longs, and that could force the markets in our direction a lot faster, a lot more aggressive than what you would normally expect. So if we do get a nice miss in that US PMI data tomorrow, we would expect that to create downside for yields. We would expect that to create downside for the US dollar. And like we've been saying over the course of the last 2 weeks now, we're waiting for a break and close below the 106. That 106 has been such a critical level. You know, if we were short this before breaking below 106, we would have been out of money, even though you might be, you know, even if you sold it a little bit higher, you would still be out of the money because your roll on this alone would probably be costing you money at this stage. So we're waiting for a break below 106. If we can see that PMI data coming in exceptionally bad, it should be enough. It should be worth a break below the 106, and that could open up a test back down towards 105.40, and who knows, maybe even something a little bit lower. Now, there's a couple of ways you can look to trade this. Like, you know, you could choose one of the pairs that's stretched right now as well. You know, for example, you've got the euro to the downside. The Aussie is very stretched. So Aussie dollar upside, euro dollar upside could be attractive. However, we've got some major data points coming up for both of these, right? For example, if let's just say the Eurozone data, the PMI data tomorrow comes in very bad, I won't be looking to short the euro on that. But let's just say it comes in very bad. You won't be looking to trade euro dollar higher if the US data comes in bad, because you want that differential, right? So if the euro data is super hot tomorrow, and then the US data comes in lower, then euro dollar upside makes a lot of sense. You know, we are trying to break out of this recent channel on the euro dollar, and the channel, it's looking a little bit weak right now, because what you want to see with a channel break, you want to see that immediate follow through. Right now, the markets have broken through it, it's retested it, but we're just kind of sitting there idle. What we would absolutely need to see for more conviction is we would need to see the markets breaking above that zone that we looked at a couple of weeks ago, right? We would need to see the markets breaking and clearing above that 106.35. If we can see that, you know, it does open up for some additional upside opportunities, maybe back up towards 106.70, maybe back up towards 107.30. So that is something that is possible. You know, you can look to trade that. I think the one thing that I will be looking at tomorrow, apart from trading euro dollar, is dollar index shorts looks attractive. Now, not all brokers offer the opportunity to trade the dollar index as a CFD. So, you know, you might not have that option, but that for me is the cleanest one that I'll be looking for, is just to trade that if the data comes in nice and soft. The other thing we could look at, is maybe equity upside if the data comes in really bad. I would prefer dollar downside than equity upside, though, just because we know where volatility is trading right now. Even if yields come down, yes, that'll be a positive for equities, but you've got earnings in the mix as well, which could be a negative risk factor. You've got volatility that is still breaking out. So equity upside on a very bad US data point could be attractive, but it's going to be more risky compared to just trading the dollar lower, if that makes sense. So keep in mind, what's good about looking for dollar shorts is that the dollar has basically not been trading alongside the safe haven flow. So for example, if you look at gold, we know gold had a massive amount of safe haven inflows. The dollar had almost none of that. Apart from that, if you look at yields, which has been grinding higher and higher and higher, let's just change these colors up a bit. If you look at yields have been skyrocketing. But if you compare that to the dollar, again, the dollar has been pushing lower. So those two things that you would have expected to provide upside for the dollar, it hasn't over the course of the last 2 weeks. And that, again, it either means that the dollar needs to catch up to those moves, right? It either means that the dollar needs to catch up to yields and to the safe haven flows, or it means that maybe the market is so saturated on the positioning side that it's very difficult for the dollar to continue rallying from here without getting a very, very good catalyst to do so. So again, it makes dollar shorts on a miss in the data the most attractive option. I would not be looking to buy the dollar if the data comes in good, just because it's just a little bit too stretched at these levels. So the dollar looks good for a miss in that data. What about Wednesday? Wednesday, we move into some CPI data, quarterly CPI data, and the monthly indicator for the Aussie. Now, this is going to be important, guys, because remember, last week we had that beautiful trade in Aussie Kiwi, which came on the back of, well, firstly, we had Kiwi CPI data coming in lower than expected. But the other positive driver was the RBA policy meeting minutes, which came in a little bit more hawkish than what the markets had anticipated. Remember, for the last few weeks now, we've been saying that the markets were underpricing the risk of another RBA hike. And what the minutes did, the minutes basically just confirmed that for the market, saying that, hey, but wait a minute, these guys actually can still hike rates, because what they said in their minutes was that, listen, we have a very low tolerance for high inflation. We want to see progress towards inflation. Otherwise, we need to act again. And the markets were like, wow, these guys could hike again. And our reaction was like, yes, that's exactly what we've been looking at over the past couple of weeks. But anyway, the reason why this CPI print will be important, more important than it would have been, is after that hawkish RBA minutes, right? The bank made it clear that they're uncomfortable with where inflation is sitting. And if we have an upside surprise, a much higher than expected quarterly print coming out for that CPI data, that could really impact how the markets view rate expectations for the RBA right now. You know, if you take a look at money market expectations, markets are a lot less sure that they're not going to get a hike. Remember that this was sitting at the high 80s before the RBA meeting. Before the minutes. Now there's an up to 32% chance that they could hike. So if CPI comes out with a big upside surprise on Wednesday, that's going to push that 32 maybe up to 50-50, and that makes that RBA. That means we could potentially trade the Aussie dollar higher going into the November policy meeting minutes, right? Just like we did back in June, remember, when we also traded something like the Aussie Kiwi. So that is really something we need to watch. Look, if the data comes in very weak on the other side, if the data comes in much worse than expected, that's probably going to be enough to push that 32% lower, and that could see some downside in the Aussie. Now, the question is, do you want to short the Aussie if the data comes in weaker than expected? Look, personally, I won't, because it's just too stretched to the downside right now. The markets have priced in a ton of negatives for the Aussie already. It's just versus the Kiwi that we are ramping higher. The Aussie is down almost against everything else. So I'm far less interested to short it if the data comes in bad. But if the data comes in really, really good, that opens up a lot of upside opportunities. Now, you could argue that the Aussie Kiwi would still be the best way to play that after the recent RBNZ dovish policy decision. And, there could be a squeeze back up towards, let's just say 109, 109.20. I'm not saying this isn't a good idea, but we have to admit that this move is looking a little bit stretched now at this stage. We got out just below that 108 psychological, as you guys know, and I'm far less interested to trade this even higher without seeing a bit of a pullback. But there are potential other opportunities. If take a look at what happened to the Swiss franc today on this de-escalation news. We've seen a very big pop back to the upside in the Swiss franc, obviously. But if we get more de-escalatory decisions and comments throughout this week, which reduces that risk premium upside in things like the Swiss franc, then maybe Aussie Swiss franc upside could be, where's that pair now? Here we go. Maybe things like Aussie Swiss franc upside could be attractive from these very, very key lows that we're trading in. I'm not saying let's buy it now. I'm saying that if inflation data is super hot on Wednesday, and at that time we've had more de-escalations taking place, then something like this could also be very attractive, because we are trading at seriously stretched levels here for the Aussie Swiss franc. But we would need to have de-escalation at that time, right? If we're just kind of sitting in this no man's land, then it's not going to be attractive. Then something like the Aussie Kiwi is probably our best bet. Listen, don't throw away things like, pound Aussie as well. If we see the jobs and the PMI data for sterling coming in much worse than expected tomorrow, that could obviously push the pair lower already. And if that is combined with a super hot CPI print, we could potentially look at a move that looks something like this, and then potentially seeing a breakdown lower towards that 189 psychological level again. So there is other opportunities apart from the Kiwi, apart from the Aussie Kiwi, but that is definitely something to watch on Wednesday. The other thing we get on Wednesday, which the markets are surprisingly excited about, and I'm not excited about this at all, is the BOC policy decision. I mean, what are they going to say? Are they really going to hike rates after the CPI data we had? Remember, we had that big miss across the board in the CPI data. We traded the Aussie CAD higher on that, if you guys recall. Let me just show you guys, where did we have that data? I think it was Tuesday. Yeah, here we go. So just a massive miss across the board in inflation. Core CPI printed with a 2 handle. Year over year printed with a 3 handle. Your median CPI 3 handle. Trimmed mean 3 handle. Everything decelerated from the prior. There's no reason for the BOC to even sound hawkish on Wednesday with this type of data. So I see the bank just doing absolutely nothing on Wednesday. I see them, why would they change their statement? Why would they change their language? The data doesn't change anything for them. So the best thing that they could do on Wednesday is literally just do a complete rehash of what they did with the prior meeting. Just saying exactly what they said the last time around, because they don't have to do anything else. They can still leave the door open for more hikes. I think if we really wanted to trade, we have to see them putting a hike firmly back on the table. That could be very hawkish. Alternatively, if they start talking about the potential for cuts going into next year, that's not something that they've been opening the door to at all. If they open the door to cuts, then CAD downside could be very attractive. But if we don't get that, then I just don't see this creating any meaningful opportunities for us on Wednesday. Now, Thursday, it gets a little bit more exciting, but also not as exciting. We've got the ECB policy decision coming up. Look, the recent data suggests that the bank is done hiking rates. The markets believes that the bank is done hiking rates. So will a hold decision by the bank surprise anybody? No. A hold is priced at 97% probability. Nobody expects the bank to hike rates. So if we get a hold, as everybody is expecting, then we shouldn't really have any meaningful reaction. Now, there's been a couple, as you guys know, I go through a ton of research reports on a weekly basis. I've gone through a lot for the ECB, and there's a few participants that think the bank, how can I put this? So inflation has come down a lot, but not so much that the bank wants to get too dovish too quick, because they run the risk, if they start sounding too dovish too quick, they run the risk of undoing a lot of their hikes, because the markets will start, running with that information, and that could actually force inflation higher again later. So they want to sound hawkish enough to keep rates high. But at the same time, the risk that we need to keep in mind here is that they can't hike rates, because that's too dangerous for growth. The other option they could do to try and sound hawkish is if they start doing more quantitative tightening, if they start maybe bringing their reinvestments, stopping their reinvestments of their PEP program a little bit sooner than what the markets are anticipating. Right now, the markets think they're going to end reinvestments only in next year. So if they say, listen, we're going to end reinvestments sooner, that could be very hawkish. The one thing that I don't think they're going to do that. The reason why I don't think they're going to do that is take a look at what the BTB Bund spread have been doing. Now, we've been talking about this quite a lot recently. The BTB Bund spread is, think of this as a risk premium for the Eurozone. Now, even though we had a bit of a move lower, the BTB Bund spread is still sitting at 2%, which is still very uncomfortable for places like Italy, places like Spain, places like Greece. They don't want to see this type of spread moving higher. If they were to come out and say that they are bringing forward or cutting their reinvestments for the PEP a lot quicker, that risks a big pop to the upside in the spreads, in the BTB Bund spread, and they don't want to do that. That risks it's too the risk is too great for refinancing costs in places like Spain and Italy. I don't think any change is likely. Again, just like the BOC, even though the markets are getting excited about a change to the PEP, I just don't see them doing that this week, because there's just too much risk on the for the BTB Bund spread to push higher. So again, the base case scenario is they just don't say anything new. Now, the euro has a tendency to sell off at ECB policy decisions, no matter what the bank does. Not always, sometimes you could see some monster moves higher in the euro. We traded a couple of them, last year and this year. But for the most part, the euro normally weakens, even though no new information is shared, but those moves can be and is often faded fairly quickly. So I'm not saying that the event can't create volatility. There can be volatility, especially if those PMI data offer some volatility tomorrow. But I'm not seeing a massive opportunity for a good trade here out of that ECB. Not like we did last time around. Remember with that, what did we trade last time? Euro Aussie. We had that beautiful trade in Euro Aussie. Can you guys remember that? I have that chart here somewhere. But I'm sure you guys remember that trade that we took out of Euro Aussie, and I'm not seeing that type of trade this week. I'm not seeing the odds skewed in that type of trade this week. So that's it's something something worth keeping in mind, but not something that I see a massive trigger for. The other data point to watch on Thursday, we get a ton of data coming out for the US. We get durable goods, we get GDP, and we get initial jobless claims. Now, for those of you who've been listening to me rant for a while now, you know that I don't like GDP out of the US because it's such old data. Think about it this way. We are a little bit more than a week away from the second month of the fourth quarter. And we are only now getting the GDP data for the third quarter, right? So it's very old news, but this is the advanced print or the first print. If there's any GDP print you need to watch, it's this one. This is the first one. This is the first look that we get at GDP. It's your second estimate and your third estimate, your final print. Those are the ones that I normally just ignore because, again, it's such old news by the time that we get it. But this one is going to be important, guys, because this is the first look, the first print we get at GDP. So, again, the way that I'll be looking to trade this data, I'll be looking for a miss across the board. If we see durable goods much softer, GDP much softer, a bad initial jobless claims, with where positioning is sitting right now, dollar downside or equity up, well, more dollar downside than equity upside, but dollar downside looks far more attractive on a miss in the data than trying to chase the dollar higher on good data. I'm not saying the dollar can't go higher on good data. I'm just saying we won't be looking to chase it higher on good data because positioning just doesn't make sense for us to do that from a risk reward perspective. So US data will be important. And in the exact same way, on Friday, we finalize the week with the core PCE data. It's not going to be as important as CPI. And honestly, at this stage, I think growth data will be far more important than the PCE data this week. And again, we can trade PCE the same way. If it's a massive miss across the board, I think that'll provide a lot more attractive opportunities than trying to chase the dollar higher. Now, the other thing we need to watch throughout this week is earnings season really ramps up this week. I mean, we get 150, I think 158 of the 500 names on the S&P reporting. And because we got a lot of those big tech names, we've got something like 45% of S&P market cap reporting this week. So it's going to be a big one. I mean, just look at this brilliant calendar from Earnings Whispers. There's a ton of names. The big ones we need to watch, as always, the big tech. Tuesday after market, we get Microsoft and Alphabet. Wednesday after market, we get Meta. Thursday after market, we get Amazon. Now, what I will be doing, as always, is I will be sending you guys in the channel, I'll be sending you an update of the earnings expectations for all of these names, basically showing you the high and low estimates for EPS, for revenue, etc., and also showing you those weightings, because even though Visa is a big name, it's not a big name in things like your S&P necessarily, but some of these names are massive when it comes to the Dow, which is more price weighted, as you guys know. So key names to watch, apart from those very obvious big names, is market favorites. Coca-Cola will be important, 3M will be important, Visa will be important. Do we get CAT? I'm pretty sure we get CAT as well. Was that next week? Let me just see. Can't see CAT now. But anyway, I will share the updated sheet with you guys, just going through all of, and Boeing as well, on that front. I will share those names with you and the weighting so that you're ready for this. As you guys know, I don't trade the individual names, but I look at the weightings because that'll impact the way that I trade the indexes. So that is worth keeping in mind. But like I said, I will update everybody on that sheet a little bit later in the session, alongside a ton of other reports as well. The CFTC data, I'll be uploading that. Also looking at the momentum indicators, the implied volatility, etc. I will be updating all of that in the channel for us.